Hi, I'm Arthur Coyne. Welcome to Arnerich Massena's third quarter MarketCast. In the third quarter, the S&P 500 index gained 4.5% and closed its 8th consecutive positive quarter. This made it the index's longest winning streak in 20 years. Ending the quarter at a new all-time high, the index is now up 272% from its March 2009 bottom. What's been driving recent returns? Well, two things: accelerating U.S. economic growth and rising corporate earnings. Let's take a look. Here, we see a steady rise in the U.S. economic growth rate, which has benefited from accelerating personal consumption, accelerating inventory investment, and decelerating imports. And earnings, having recovered from last year's slump, are trending higher, with energy and information technology leading the way. But we need to note that while U.S. earnings were up a healthy 11% from a year ago, earnings abroad were up even more on aggressive monetary policy stimulus and rising consumer demand. This powerful earnings growth has helped lift stock prices worldwide. Looking at returns, emerging markets and international stocks led the way this quarter, as they have over the previous two quarters, followed then by U.S. stocks and bonds, where returns were driven mostly by current income, although global bonds also benefited from a weakening U.S. dollar. When we look at 2017's year-to-date returns, we can see how strong the global stock market rally has been this year. In this chart, the blue bars show the year-to-date 9-month returns, while the gray bars show the trailing 25-year averages. What we're seeing this year is not only that equity returns are now running well ahead of their annual averages, but also that international and emerging markets, areas that have underperformed U.S. stocks over the past 25 years, have lately been leading the way. So the question is, which regions are looking cheap or expensive today? When we take a closer look at the price to trailing 12 months earnings ratio, we can see two things. First, we see that U.S. stocks are currently trading at a significantly higher PE multiple than international and emerging market stocks. And second, when we compare these PE ratios to their post-crisis averages, we see that stocks across all regions are trading at a higher price earnings multiple than usual, with U.S. stocks appearing to have the highest price premium at this time. Looking to the future, we have three main tactical views. First, we continue to believe that international stocks are well positioned to outperform domestic stocks over the intermediate to long term. Our view is to remain overweight international equities versus the global benchmark, which was made up of 52% US and 48% international as of September 30th. Second, with the recent run-up in earnings growth rates and growth stock prices, we believe that value stocks have become increasingly attractive. Our view is to remain overweight value stocks versus growth stocks. And finally, as we expect growth to recover and central banks to unwind their monetary stimulus, we believe intermediate and long-term bonds do not provide investors with adequate compensation for taking interest rate risk. Our view is to maintain a lower duration within fixed income investments. Your advisor will keep you informed as investment opportunities become available. For more information, visit us on the web at arnerichmassena.com. Thank you for joining us.